You're facing an 8, maybe 9-figure liquidity event. Today, we're talking a business sale, but it could be a concentrated stock position, stock option exercise, or a tender offer. We're gonna go through 11 high-impact tax strategies in the next 10 minutes. Buckle up, we're gonna move fast, let's go. Strategy 1. Long-short equity SMAs can generate tax losses while giving you diversified equity exposure. For example, a $10 million portfolio funded with cash could generate capital losses even when the account has grown in value substantially. These losses can then be used to offset the gains from the sale of our business or another capital asset, potentially saving millions of dollars in taxes. Strategy 2. Tax-aware hedge funds often run a similar tax loss harvesting strategy as long-short SMAs, but with deeper structure. Specialized trader funds in particular can generate active losses each year. These are ordinary losses, meaning they can offset ordinary income, not just capital gains. That can offset W-2 income, business income, board fees at the highest tax bracket. For a high net worth family with a major liquidity event and ongoing high earned income, this thing becomes an offset machine. Quick heads up, one of our later strategies can eliminate tens of millions of dollars in capital gain. Don't miss it. Strategy 3. Qualified Opportunity Zone funds are an alternative investment where after the sale is completed, we invest part of the proceeds in the fund. We're able to defer an equal amount of the gain from the sale to a future date, up to 5 years if we start in 2027. We can potentially reduce the capital gain by up to 10% as well. And the actual capital appreciation of the investments made, which are typically in real estate projects, can be 100% tax-free if held for 10 years or more. This strategy allows us to defer realization of a big portion of our gain from the business sale and allows us time to harvest losses to use to offset that eventual gain. Strategy 4. A charitable remainder trust is a tax-exempt trust that you fund with a portion of your business interest before the sale closes. You get a partial income tax deduction upfront based on what eventually goes to charity. We then sell the business inside the trust. Now, the capital gain doesn't disappear, but because the trust is tax exempt, no tax is due at the time of sale. Instead, you receive income payments from the trust over your lifetime or a set term. Those payments are taxed as you receive them at whatever character the gain was inside the trust, typically capital gain. So the real power isn't elimination, it's recognition of the gain spread out over many years or your entire lifetime, plus a current income tax deduction, plus a lasting charitable legacy. Strategy 5. Qualified small business stock under Section 1202 is one of the most powerful tools in the tax code. If your business is a C Corp and you've held the stock for at least 5 years, you could potentially exclude up to $15 million of capital gains per shareholder, or 10 times your basis, whichever's greater. Completely tax-free at the federal level. On a deal where you and a co-founder both qualify, that's potentially $30 million of tax-free gain. Now, stack QSBS across non-grantor trusts, you might be able to multiply that exclusion across multiple taxpayers. But the rules are very strict. You want to confirm your QSBS eligibility way in advance. Strategy 6. Estate freeze techniques let you transfer the future appreciation of your business outside of your taxable estate before the sale. You gift a portion of your equity into an irrevocable trust like a GRAT, an IDGIT, a SLAT, a dynasty trust at today's pre-sale valuation, often with a 25 to 40% discount for lack of marketability and lack of control. Then the sale multiplies the value inside the trust, outside of your taxable estate. Move 20% of a $40 million business into a properly structured trust at a discounted valuation, and you've shifted $8 to $10 million out of your estate at a fraction of the gift tax cost. Wait until after the sale, and you've missed the window entirely. The freeze only works while the value is still illiquid. Strategy 7. Deciding between an asset sale versus stock sale is one of the most impactful decisions to be made on your business sale. In a stock sale, you sell your equity, taxed at long-term capital gains rates, currently 20% federal plus net investment income tax. It's clean and simple. In an asset sale, the buyer purchases the underlying assets and the proceeds get allocated across categories. Equipment can be ordinary income recapture. Inventory is ordinary oftentimes. Goodwill is capital gains. Non-competes are often ordinary income. Buyers usually want asset sales because they get a step up in basis and avoid legacy liabilities. Sellers usually want stock sales because they can pay one rate on the whole deal. The negotiation between those two positions can swing your tax bill by millions. We got a few more to go, and the last one might be the most overlooked play in the entire video. Strategy 8. Installment sales let you spread the recognition of your gain across multiple tax years instead of taking the full hit at closing. When the buyer pays you over time, 3 years, 5 years, 10 years, you only recognize gain as you receive the payments. On a $40 million deal taken as an all-cash close, you recognize $40 million in 1 year. Take the same deal as an installment sale paid over several years, you spread out that gain across multiple years, potentially keeping you out of the top tax brackets. The trade-off is real though. You take on credit risk to the buyer, and the IRS charges interest on deferred gains above $5 million. But for the right deal, an installment structure can be highly impactful and potentially save millions in taxes. Strategy 9. The timing of the sale can potentially shift tax liability into a different year, and sometimes into a different administration with different tax rates. A December 28th close versus a January 4th close means the gain hits this year versus next year. Closing in January gives you a full extra year to plan, more time to harvest losses, to make charitable contributions. The buyer rarely cares about your fiscal year, but you should. Don't let the buyer's timeline drive yours without a tax model running in parallel. Strategy 10. Income deferral plans turn the years right around your sale into a potential tax shelter. The principle is simple. Push as much income as possible into qualified retirement vehicles in the years where you're at peak earnings. Pull it out later when you're in a low bracket. A properly designed cash balance plan layered with a 401k and profit sharing can shelter hundreds of thousands of dollars of income annually for a business owner. That's a deduction at the highest federal brackets. After the sale, the strategy doesn't have to stop. Board seat income, consulting income, an advisory role with the buyer. That earned income can fund a solo 401k. Used aggressively in the 3 to 5 years around a sale, this strategy alone can shelter more than $1 million of income from current year taxation. And strategy 11. A sale to an employee stock ownership plan or an ESOP is one of the most powerful exit strategies that exist in the tax code. If your business is structured as a C Corp and the ESOP ends up owning at least 30% of the company, you can potentially elect special tax treatment, defer the entire capital gains tax on that portion of the sale by reinvesting the proceeds into qualified replacement property. Done right, that deferral can become permanent, meaning a significant exit could result in zero federal capital gains tax during your lifetime. The trade-offs are real, and these structures are very complex. You're selling to your employees rather than a strategic buyer. But for the right founder, the legacy benefit and the tax outcome are unmatched. Remember, these are complex and have to be done right, so work with an expert. Here's the thing. None of these strategies create an optimal outcome in isolation. The real power is in the sequencing and the combination, picking the right entity structure in advance, timing the close, choosing the right deal mechanics, harvesting losses at scale, and then coordinating the post-sale investments into one cohesive plan to continue to harvest losses. That's where you actually move the needle on reducing tax. You deserve an advisor who understands all of these strategies, plus everything else that's out there, and someone who can coordinate them into one plan that's built around you. If you're facing an 8 or 9-figure liquidity event in the next few years, reach out to our team. There's absolutely no reason to pay our friends at the IRS more than you have to. The link to schedule a brief intro with our team is in the description below. If you found this valuable, subscribe for more deep dives like this one. We're going to keep bringing content around liquidity events like business sales, stock sales, real estate sales, stock option exercise, tender offers, how to save on taxes, the family and behavioral side of it, and how to structure your overall wealth plan. I'm Jake Hughes with Blueprint Financial Group. Thanks for watching. Bye, everybody.